Welcome to The Explainer. Today, we're tackling a huge question for anyone who's ever thought about putting money in the stock market. You're staring at a screen with literally thousands of stocks. Where do you even begin? It's a feeling we all know, that sense of being totally overwhelmed. But you know what? The answer isn't out there in the market. It actually starts with you. It starts with your goals. So let's dive in. So here's how we're going to break it down. We'll start with the most important question, your starting point. Then we'll check out the classic strategies, some high-growth options, and how to think about risk. And finally, we'll pull it all together so you can figure out what works for you. Okay, first things first. Before you look at any specific stock, any chart, or any company report, there's a fork in the road. You have to make a choice. So what's it going to be? Are you in this for the short-term thrill, like you're in a stock market game trying to score quick profits? Or are you running the long-term marathon? You know, building real, sustainable wealth for things like retirement. Seriously, your answer to this single question, it changes everything. All right, let's get into the big two. These are the foundational strategies, kind of the classics of stock picking that have been around forever, each with a very different take on things. First up, value investing. Now, the idea here is super simple, almost like a treasure hunt. You're looking for great companies that are, for whatever reason, trading for less than they're actually worth. It's the classic idea of trying to buy a dollar for 50 cents. But, and this is a big but, simple does not mean easy. Value investing is incredibly demanding. You have to do some seriously deep research. And let's be real, predicting the future? Pretty much impossible. Plus, with so many smart people and so much money chasing the same deals, finding those true hidden gems, well, it's getting harder and harder. Now for the second classic approach. Instead of hunting for bargains, you focus on companies that consistently pay you to own them. They share their prospects directly with you in the form of cash. This strategy is all about that steady, reliable income. A famous, rules-based example is a method like this one. You just buy the 10 highest yielding stocks from a major index, hold them for a year, and then do it all over again. It's a disciplined way to stick to the strategy, and you can apply this logic to pretty much any major market in the world. But, and you really got to hear this, a high dividend yield can be a huge red flag. It can be a trap. Think about it. During the 2008 financial crisis, a lot of bank stocks had these amazing looking dividend yields. Why? Not because they were doing great, it was because their stock prices were crashing. That high yield was actually a warning sign of deep trouble. Okay, let's shift gears completely. We're moving from the slow and steady to strategies built for pure speed. These are the approaches you might think about for those short-term goals, like trying to win a stock market game. This is all about finding the next big thing. Forget dividends. These companies are pouring every single penny back into the business to fuel massive expansion. We're talking about companies at the cutting edge of AI, fintech, or cloud computing. You're not betting on their current profits, you're betting on them dominating the world tomorrow. These stocks are defined by explosive growth in exciting industries. But because their prices are based on high expectations for the future, they often have sky-high valuations and can be incredibly volatile. The risk of getting caught in a bubble where prices just completely detach from reality, it's very, very real. An even simpler, related idea is momentum investing. The philosophy here is the trend is your friend. You're not analyzing the business fundamentals, you're just buying stocks that are already going up, believing that winners will keep on winning. It's pure trend following. So far, we've covered strategies defined by value or growth. Now let's explore a set of strategies that are defined by their specific approach to risk, quality, and the size of the company itself. This is a long-term strategy that prioritizes stable, best-in-class businesses. You're looking for companies with a strong market position, great leadership, and solid balance sheets. The catch? Quality is rarely cheap, and even the best companies need to be reevaluated regularly to ensure they haven't lost their edge. Here we see a perfect contrast in how to approach risk. The small cap strategy embraces risk, betting on smaller, less established companies in the hope that they become the giants of tomorrow. The safety strategy does the exact opposite, prioritizing the protection of your capital above all else by demanding a huge discount to a company's true value. Beyond value or growth, some investors focus directly on a stock's turbulence or its volatility. This measure of price swings isn't just a risk factor. For some, it's the entire game. This is why an index like the VDAX is called the fear indicator. High volatility is a sign of market-wide anxiety. But here's the twist. While that fear sends some investors running for the exits, it's the exact signal short-term players look for as a massive opportunity. Okay, wow. We have covered a lot of ground, from value to growth, from quality to momentum. So let's bring this all home and build your personal compass for navigating the market. This chart really lays it all out, doesn't it? If your goal is a short-term win, like in a stock market game, high-octane strategies like growth and momentum are your tools. But for the marathon of building personal wealth, a more defensive and patient approach, like value, safety, or quality, is almost always the wiser path. So, the crucial point is this. Anyone who tells you there is one single best way to invest is wrong. The most successful investors aren't the ones who find a secret formula. They are the ones who know themselves first and choose a strategy that fits their own personality and goals. So, you've seen the map and the different paths laid out. The feeling of being overwhelmed is gone, replaced by choice. The only question now is not what to invest in, but who you want to be as an investor.